What's up, everybody? Welcome to the Life Cycle of a Trade, the series where we break down the thought process behind trade entry, trade adjustments, and closing order. In this video, we are going to cover a poor man's covered call. All right, looking to get a couple trades on this morning. E-minis up 16, the NASDAQ up 120, volatility at its lows, which lends us to a new type of trade that we haven't done in this portfolio. I'm going to be looking at Target. Target trading at 130. It had earnings a couple weeks back. The stock moved from 155 all the way down to 120. It's bounced a little tiny bit to 130 here. But even if you look on like a longer term chart, let's just look at like 5 years. We'll go back to the monthlies as well. I mean, we have reversed years of price movement. We're back to, early 2021 here, mid to early 2021 prices. I think it's an interesting spot to get a little bit of long delta here and do something that we haven't done in this portfolio, poor man's cover call. So this is a more capital efficient way to be long the stock, short a call, covered call. So when you buy stock in a margin account, you get about 50 or 2-to-1 leverage on your stock, right? So it uses about 50% of the cash value of the shares. So if you were to buy 100 shares at $130, it would use the notional value of that position would be $130 per share. So 13 grand on that position. In buying power, you only use half of that, so $6,500 in buying power, around half that value. Selling the call in this circumstance, and I just picked the January expiration just to show you this example, would reduce the buying power a little bit, but you're still using $6,200 to be long the stock, short the call. Very capital intensive position, even in a margin account. So for me, in a smaller sized account, I have to figure out a way to be more capital efficient while still maintaining that position or that sort of delta. So what we do in a poor man's cover call is we go a little bit further out in time, let's say 50 to 90 days, depending on your duration here. I'm going to look at February, which is a little bit further out in time here. And we'll want to be long a call that is in the money, that'll be at a delta that's, somewhere between 80 and 95, right? When you get to a higher delta, the option is going to get more expensive. And you can see this on the chain here. In terms of the value of the option, the further you go in the money, the more of the value is intrinsic value versus extrinsic value. When you think of extrinsic value is equal to the out of the money put. So if you were to buy this 110 call, for example, you would be paying 51 cents or around 51 cents over the intrinsic value of this option. And so that $51 is essentially the cost of that long stock position or nearly long stock position. So for me, I want to use about $1,000 would be like my max on this. And that's just for my position and my capital efficiency in this account. You can go further in the money if you'd want to, if you don't mind using a little bit extra capital. So for me, I'm going to go and say around this 120 strike. So this is going to be a little bit lower delta than I'd like to be at, but I'm trying to keep this at about $1,000. In terms of the short call, we want to go in that normal, 30 to 50 day time frame for the short. The long 50 to 80 days, so you have that about 40-day window, 30 to 40-day window between the two options. So in January, I would look at somewhere around the 135 strike. I'm going to sell that at $3. You'll see this uses about $1,000 in buying power. You have a total of 36 deltas, which is a little bit low. The delta on this option is 38. So if you were long stock short this call, you would be net 62 deltas versus me that I'm going to be at 36 deltas. So a little bit lower delta exposure than the actual cover call would be, but I'm using 20% of the capital that you would use to be long the stock, short the call. In terms of my break even, you could see my extrinsic value on this position is basically zero, which means that I'm my break even is right at where the stock is trading, so about 130 on this position. When we look at this on the risk profile here, so we go to the curve mode, we click this analysis button, you can see this sets up very much like a normal cover call. If we look at the at expiration, you have basically that cover call type risk profile above 135. There's no more profits to make. Your break even to the downside is going to be at 120 because you have that capped risk. You are synthetically long a put here because you don't have the physical shares. So a very capital efficient way to be long the stock for pretty decent amount of time. So we're going to put this on 1062, see if we get filled on this position. No fill there. Move this 1065. All right, so we're filled 1065. That puts us at break even right at the stock price. Our poor man's cover call. Closing order here coming up in Target. It's been just 1 week. The stock trading at 130 and change. It is now at 136, so we've had a 6-point rally. This was a perfect move, and it happened very, very quickly, so it's time to go on this position. So when we close this position out, we would be looking at buying back our January option, which is our 135 call, and then we would be selling to close the synthetic stock position, the 120 call we had in February. This is currently trading at 1290-ish, depending on where we got filled. It'd be somewhere around a $225 profit, depending on where we get filled. So let's try 1295. Not a whole lot to say for this one. I mean, just given the move that we've had in Target, that's why we're at this amount of profit. I mean, we had, a pretty sizable amount of long delta going into this. Let's go 1285 just to get filled. There we go. We got filled. $220 profit on this poor man's cover call. Synthetically long the stock, short the call.